That long list of goals comes also with challenges. Robert Scott of the Economic Policy Institute discusses how realistic China's growth targets are and the biggest hurdles that could stand in the way.
Well, I think that's not particularly surprising. China has to only grow about 8% a year in order to hit that target, and that's actually somewhat slower than it's been growing for the past decade. So I think it's consistent with current Chinese economic policy.
It may be consistent, but is it realistic? I mean, after all, the country has gotten significantly bigger over the last decade. There's been a lot more zeros that's being added to the bottom line in terms of GDP. It naturally is harder and harder to grow as you become bigger and bigger.
Well, China does have a problem. It was easier to catch up to the rest of the world than to move ahead at the cutting edge of technology. So China is going to have to invest much more in R&D and continue to invest in infrastructure if it's going to be able to maintain those high rates of growth. But I think the bigger challenge for China is to shift from its reliance on exports as the engine of growth to relying much more on domestic consumption. I think that's going to be the much more delicate transition that is required to sustain growth within China.
One of the biggest talking points within China and also from folks outside of China as well is the wealth distribution or income gap, call it what you will. The news most recently is the goal of doubling per capita income as well by the year 2020. Share with us how realistic and how significant of an announcement that is.
I think that's a very encouraging announcement, because what that means is that if they do it by, say, doubling wages, that will allow the average working family to see a much higher level of income. Now, you do have to be concerned about how that income growth is going to be allocated, how it's going to be shared in the economy. In the United States, we've seen fairly rapid growth in income over the past decade, almost all of it going to people in the top 10% of the income distribution. You certainly don't want to see that reproduced in China. I think that will lead to tensions that will tend to further pull apart I think the political stability within China. That would not be sustainable.
Well, there's also the question from the business side in terms of economics is profitability. The millions and millions of factories within China that have these workers. I'm sure they might have a slightly different view of doubling the wages of all of their workers. What effect does that have on inflation? What effect does that have on sort of the stability of business profitability?
Well, I think it depends critically on productivity. If productivity grows at 5 to 10% a year, as it has been in manufacturing, they can sustain much more rapid wage growth. The question is, are they going to hold on to those gains in the form of profits? That's what's been going on in China for the past decade or two. Or are they going to begin to share more of those earnings with workers? And I think that's the central question that's going to face not only businesses, but the Chinese economic authorities.
In terms of risks over the next 5 years, there's been a lot of talk about the banking system, income inequality, and there's a substantial list of challenges ahead.
Yes.
In your mind, what's the #1 risk?
Well, I think the biggest risk is actually probably a resurgence of inflation. There have been repeated property bubbles in China, as we saw in the United States. If you have a property bubble or a financial bubble and it leads to a crash, that can lead to prolonged economic destabilization. Certainly it has in the United States and other Western nations, and I think China faces many of those same risks today. So there is a link between getting their exchange rate policies under control and their monetary policies under control. Those two are tied together.
Professor, great analysis. Thank you very much. We'll have you back again, certainly. Thank you.
Thank you.